balance of payments and balance of payments theory. In the last two videos we learned about the current account, which measures trade flow into and out of a country, and the capital account, which measures capital flow into and out of a country. These two accounts combine to form the balance of payments. The balance of payments is a record of all transactions made between one particular country and all other countries during a specified period of time. If all transactions are included, the payments and receipts of each country are and must be equal. In other words, they must balance. Although the totals of payments and receipts are necessarily equal, there will be inequalities. Excesses of payments or receipts, which are called deficits or surpluses, in particular kinds of transactions. In other words, there will be surpluses and deficits, but when put together, theoretically, it all balances out. The balance of payments theory. The balance of payments theory states that an exchange rate must be at its equilibrium level, which is the rate that produces a stable current account balance. In other words, the exchange rate will go up or down until trade between the two countries balances out. If a country has a trade deficit, that country's currency will go down because more money is flowing out of the country to buy imported goods. The drop in the country's currency will make the country's exports cheaper and imports more expensive, which should balance out the currency. Now let's break that down. First, let's look at how trade affects exchange rates. Let's say a company or person from country A buys a good or service from a company in country B. The company or person from country A pays for that good or service. In the process, the money the person or company pays gets exchanged from country A's currency into country B's currency. This means the person or company is selling the currency from country A and then buying the currency from country B. This adds supply to the currency from country A, causing it to weaken, and adds demand to the currency from country B, causing it to strengthen. Now let's apply the theory to trade between two countries, the US and Canada. The US and Canada are each other's largest trading partner. Although they trade goods and services back and forth, the US has a trade deficit with Canada, meaning Canada exports more goods and services to the US than it imports from the US. This means that when these goods and services are paid for, there is more US money being exchanged into Canadian money than there is Canadian money being exchanged into US dollars. More money being exchanged from US dollars into Canadian dollars means there is more US dollars being sold than bought, and more Canadian dollars being bought than sold. This adds demand for the Canadian dollars, causing them to strengthen in value, and adds supply to the US dollars, causing US dollars to weaken. As the Canadian dollar gets stronger and the US dollar gets weaker, the US dollar now buys less Canadian dollars. This means it costs more for US residents to buy goods from Canada. This lowers demand for Canadian goods. This also means it now costs less for Canadian residents to buy goods from the US. This increases demand for US goods. The balance of payments theory states that the exchange rate will keep appreciating or depreciating until the supply and demand for goods between the two countries hits an equilibrium. In other words, until there is a balance of trade. If a country has a trade surplus, in other words, they export out of their country more than they import into their country, their currency will appreciate in value. If a country has a trade deficit, in other words, they import more into their country than they export out of their country, their currency will go down in value. Like all economic theories, this theory has its problems when applied in real life. Like most theories, this theory only looks at a single factor and ignores other factors that will affect exchange rates. The balance of payments model focuses largely on tradable goods and services, while ignoring the increasing role of global capital flows. In other words, money is not only flowing into and out of countries for goods and services, but to a larger extent, financial assets such as stocks and bonds. The increase in capital flows is the basis of the asset market model, which is the subject of our next video. So that's the balance of payments and balance of payments theory. In my next video, we'll look at the asset market model, which concentrates on the other half of the balance of payments, capital flow. See you then.